Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We are going to try to help you improve your retirement today, really by answering your questions. And so we get questions during the week. We have questions that come up during our strategy sessions with the clients that we, cover. But you can ask questions here during the live show if you'd like. Send in an email to that asktom@talkmoneywithtom.com address, or put it in the chat, and we'll answer your questions today. We get lots of questions, for example, about the debt ceiling, so we'll spend some time talking about that today also, of course. And, we're huge believers, and the reason we started this channel actually was because we think that education is, lacking in the area of retirement planning, tax planning, and asset management during retirement. And so that's what this show's about. We're happy to cover any of those subjects and try to help you out as far as that goes. So you can send, any questions in during time. You can also subscribe to the channel. Hit the subscribe button. There's a little bell next to there if you want to get notified every time we put something new on there. We feel like this is a really good resource, and we're glad that you could join us today for that also. And then lastly, of course, if you want to meet with Ethan and I, just ask some questions, on your own, some more custom questions about your specific situation, you can do that by just booking an appointment. Our schedule's available online. You can go to the website. Up in the corner is a button, looks just like this yellow button here, and push that. Pick out a 30-minute video or phone time to meet with Ethan and I. We'll discuss, your specific situation. So I look forward to being able to help you today. Hopefully there's something you can kind of grab onto and really be able to use for today and help you for the rest of your retirement. If you're not retired yet, still really important information to get you ready for retirement. If you're already retired, then stuff that you can do maybe to help and improve your situation also. So I always like to start off the show with a summary of kind of what we saw happening in the stock market for the past week. It's actually been a couple weeks since we had the last show. And we feel very strongly that, the more you know about the market, the easier it is to, have a more successful retirement. Unfortunately, the stock market, which is represented here by this S&P 500 green squiggly line, is kind of this roller coaster that we all have to deal with. But over a long period of time, it has worked out to be a pretty good investment area, specifically to help people keep up with inflation. There's two main areas that my clients have had growth in: the real estate, specifically the home that they own, especially here, and in the stock market itself, with the growth that it's had. These are the things that help you keep up with inflation. And so the downside to the stock market is just this right here. Look at this roller coaster and this red line showing the trend for last year. And so why are we doing this, right? And so the more you understand about the market, I think the more comfortable you can be with the market and the more you can kind of stick with it, right? So that's what this is about. So if you go back here to the beginning of this chart, that was the very high point for the stock market, the S&P 500, at the very beginning of last year. And then we had this red line connecting these kind of highs that were happening, all of them lower, right? Yep. One of the classic definitions of primary trend is when the highs are lower, you're in a downward primary trend. And so what we're really looking for now is a reversal of that primary trend. We would like to see this reverse. So for the first time this year, we actually made a high that was higher than the high before that. And then just now, just the last couple weeks, and actually today, we are setting a new high for the year, right? This is exactly what we want to see. We want to continue to see these highs come in at higher levels, right? Even in the midst of all this debt ceiling issues that we're dealing with right now, we are currently, right as we sit, really at the highs for the year, right?
Yeah, which is kind of crazy because every other previous debt ceiling, we've been down, 20%, 10%, 5%. So we've always been down. But maybe it's when someone cries wolf, people are saying, oh, this is a buying opportunity.
That's exactly right. I mean, we are seeing over time, and we've presented this a couple of times on the show due to questions about the debt ceiling, that if you go back and look at the arguments, there's been less and less drop, right? But this is pretty severe. We've had almost no drop whatsoever. And again, I think that people are using this as a chance to come in, and we're seeing tremendous motion in certain areas, and we'll talk about some of those areas here in a moment. But let's talk somewhat about the debt ceiling, because it is the biggest issue. It's kind of clouding all of the other things that are happening, both good and bad, and rightfully so. It's a really big deal. We're supposedly running out of money sometime between June 1st, which is next Thursday, I think, and the 10th, give or take. Quarterly payments come in June 15th.
Yep.
So that's a big cash flow into the Treasury. And so what's happening is, at least from what we've heard from Janet Yellen and the CBO, the Congressional Budget Office, basically just don't have enough money to get to the quarterly standpoint, right? We were originally told that we would have money likely until the middle of summer to end of September.
Yeah, there's speculation because so many counties in California got tax relief, then they got to delay their payments till October.
Yep.
That it's just causing a cash flow issue.
Yeah, I mean, you think about it. If you're here in California and you don't have to pay until October 16th, you're probably going to wait.
Yeah.
It makes sense. But if they owe you, you probably already filed.
Mm-hmm. You're taking
So
your money.
you got your money. So that's a negative for the Treasury. And again, California, I think, is the 6th largest economy in the world. So an awful lot of the counties here were given emergency relief because of all the rain that we had and the flooding and such that came from that. So these are things that are kind of compounding the situation as far as that goes. So right now, they're in the middle of negotiations to try to figure out how to get a bill together that can pass both the House and the Senate to raise the debt ceiling. So just as a point of information, the debt ceiling is a mechanism where Congress allows the Treasury to borrow up to a certain level. 31 trillion is the number now, which we hit a while ago, back in February, and we've been using these extraordinary measures. But this debt ceiling concept was originally put into place back in 1917. Prior to 1917, Congress had to approve the issuance of every single tranche of Treasury bills, bonds, notes, etc. So obviously that became too cumbersome, so they said, okay, we'll just put a level. Treasury can issue whatever they want up to that level, and then they come back to us. And so that was fine. It worked out great until kind of the Tea Party movement in 2011. And that was the first time that they figured out that they could weaponize, the debt ceiling. And unfortunately, we still have it. Australia was the last country that had it, other than the U.S., and they got rid of it. We're still hanging in there on it. And there was some talk of trying to get rid of it before, several times, hasn't happened. So have to get the money approval to borrow at a higher level in order to pay the bills. There's still cash flow coming in. And I used this analogy before, like if you have $100 worth of expenses and you're making $75 a month, you're going to have to borrow $25 a month, right? And so you still have the $75 and you'd have to prioritize where you're going to spend that. And so there's been virtually no clarity on what that priority would be. What do they pay the Treasury interest? Do they pay Social Security? My vote is that they hold off on paying Congress, personally. I know that won't matter that much in the overall scheme of things, but it might matter to them.
Yeah.
Nonetheless, so there's some conversations that are happening there, behind the scenes. There's also some extraordinary measures above and beyond with the Federal Reserve being able to insert liquidity in the case of a default, where they would basically stop. Right now, they're letting bonds shed off of their balance sheet, what they call quantitative tightening. They would stop doing that potentially. These are conversations that they've had in the past with past debt ceiling issues. And then possibly even start buying treasuries to kind of create liquidity. And even if there's a debt ceiling resolution, the Fed may want to consider that, just because there might be an awful lot of liquidity needs that the Treasury has. So they try to issue so much in bonds all at once. If the Fed is actually selling bonds, that doesn't help. So having them stop that and or even purchase bonds to create some of that liquidity to get the Treasury kind of replenished with money so they can go forward. So we are seeing some issues with the bond market. Our current signals right now have actually changed. The signals for the stock market was yellow on the short term, or the fast motion. It's now green as of today. And so we were going to make some changes this morning, actually, based on the yellow, but the motion today is just so substantial. We decided to hang off, and it's turned to green now, so it's good. But the key thing really for us is that we're in the right places. I mean, we're in the QQQ, which is the Nasdaq 100. That's really going. We're in, the cybersecurity and cloud computing and self-driving vehicles and a lot of technology pieces that, have been very, very good, in my opinion, for the last couple of weeks here. So we're going to ride that here and see what happens, on Tuesday, Wednesday, and see how this plays out as far as that goes. Right now, the debt ceiling, negotiations. Oh, the last piece, I'll cover the bonds signals. Those are still the same. We have a red on the fast and a yellow on the slow. And again, the reason the bond market is reacting negatively is because of the fact that the Treasury is going to have to issue so much in bonds to catch up. So there's some concerns about that. Those concerns might be justified. They might not. Depends on what the Federal Reserve does in terms of providing liquidity. So we'll see how that plays out. But some time ago, we got quite conservative in the bond area, very short-term inflation protection securities and T-bills and those types of things, just to kind of insulate, the fluctuation that's happening in the bond market. And so back to the debt ceiling, the conversation right now is about putting some spending caps on what they call discretionary spending. And they're trying not to put too many criteria on that. They're going to let Congress kind of battle it out in the normal budgetary process, because the budget's due at the end of September anyway, with a couple caveats, right? They want to insulate a cap for veterans. For the military, I believe military, they're looking at a 3% increase. And they want to have a cutback on some of the money that was funneled towards the IRS in that last bill, which I find kind of interesting. That's a huge hot subject, the money that the IRS got and how many agents they're going to be able to hire and all of this stuff. And so, I find that kind of fascinating. But nonetheless, the rest of the subjects, at least at the moment, seem to be things that they'll negotiate at some point in the future, where they would keep for 2 years, the costs at the same level, which is a cut, right? Because things cost more. There's more people that are in retirement, so we'll see how that happens. In the 2011 negotiations, that's what they ended up with, was caps on different categories. Some of those actually got ignored to a certain degree, actually, in the end. So we'll see how that plays out. That would be great, to be honest, if they can just come to some resolution, get this passed. So the thought process is that resolution should happen, according to the news, today, tomorrow, and that Congress could be voting on it Tuesday or Wednesday.
Yeah, Kevin McCarthy promised that everyone would have 72 hours to read it before their vote be held. So, and the nice thing about this debt ceiling agreement is they want to have it for 2 years.
Yeah.
Which is kind of nice when you don't have to worry about this for 2 years till the next presidency, essentially.
Yeah, exactly. And so that because look at, if you think about what's happening here, they're only $70 billion apart, apparently, on essentially a $12 trillion plus budget. So they're fairly close together, and I keep hearing different things about that, but it seems to be good. The market's moving. So you always got to watch the markets, because somebody has better information than we do. Right? They just do. I mean, you're in those negotiations. Those rumors get out. People know if it's getting close or not. And the fact that the market is going up a lot has somewhat to do with NVIDIA, which we'll look at here in a moment. But certainly, I think also somewhat to do with what's happening with the debt ceiling. In the last two debt ceiling arguments in the end of 2021, the market started to move before the announcement was made that there was a deal cut. I very specifically remember that. And again, watch the price, right? When I talk about the price, and let's look at the S&P 500 here, this green squiggly line, make sure you understand, and this is a key educational point, the market knows kind of what's happening to a large degree. Once in a while, the market's surprised, but most of the times, the information that's in the market is kind of stuff that we don't always know, but if you watch the price, then you know.
Yeah, there's been a saying lately, buy the rumor, sell the news. And so that it's kind of right now people are buying the rumor that there's a debt ceiling.
Yeah, that they're going to have an agreement. So, we'll see how this plays out. There's always room for error here and different things that can happen. But, the market's excited about that. But there's another key piece of information that happened this week. And that had to do with, whoops, sorry. Oh, it's not changing on there. That had to do with, get it?
Let's see. Go.
Nope. Yeah. Let me try going back to here, and then back to here. Where my projector's not changing, which is probably fine. We don't have to have the visual here too. So that has to do with NVIDIA.
Mm-hmm.
So NVIDIA is up over 160% year to date,
Yeah.
and had about a 30% run, give or take, since they announced their earnings.
Yeah.
After hours on Wednesday. And so it's considered one of the historic beats of the expectations in terms of, what they reported versus what was expected was so much higher. And then on top of that, their guidance going forward was really, really powerful and really effective. And so, that stock has been moving. Of course, it's a big stock, which makes a difference to the types of investments we buy, because we buy these indexes like the NASDAQ 100 and, the S&P 500 and those types of things. And these are all weighted based on the size of the stock. And so a big company like NVIDIA having a huge move can really kind of drive things, right? And obviously the big issue that they're dealing with there is artificial intelligence.
Yeah.
Right? You have any insight on kind of why they're doing so well in that arena?
So with AI, you have essentially a lot of it's in data centers, and NVIDIA's makes up 90% of the GPUs in data centers. And so they have essentially a monopoly there. And so they're gearing towards all their tech. They're moving away from consumers and going towards AI. And they see that's where the money is.
Yeah, they've had that volatility on the consumer side and the gaming, that kind of came and went in 2020.
They made a bet on crypto.
Right, crypto is another
that
one.
was a big flop for them.
Yeah, exactly. So data centers are probably much more consistent, big money pockets and what have you. And there's money to be made, by the companies that have those data centers, obviously in using AI to, analyze that data as far as that goes too. And now, the processing power of the GPU has really started to replace the CPU, especially in these big, connected scenarios like NVIDIA works with. So that's the big issue. I mean, this is, I've had so many conversations with clients that they feel like the market is falling right now, and it's not. It's just because we're hearing all these bad things about the debt ceiling. They feel like the things aren't that great. They really are. If you look behind the scenes, you look at these companies, I mean, what type of massive downturn do you have when a company like NVIDIA is up over 160% year to date, right? When unemployment is very low. Now, unemployment is a lagging indicator, but we're at near record lows on unemployment, right? When there's still over 10 million jobs open. Again, employment is a lagging indicator, but those are big numbers. I mean, in order for those to kind of come down and unemployment to go up, it's going to take a while from where we are.
Yeah.
And, all the news, if you go back to that low point back in October, we're going to go way lower, all the way through. The market has been hitting new highs here 3 times in a row in the middle of all of this negativity from the professional investment arena. And the market is climbing this wall of worry. Yet again. I mean, that's a saying that happens quite often. So it's really kind of fascinating what's going on right now altogether. Earnings were very good, I felt, versus the expectations. Companies were beating the expectations on a very nice pace for this last quarterly. And then NVIDIA, which is very late in the cycle of quarterly reporting, just knocked it out of the ballpark and kind of made the emphasis there. Things are not bad. You take away this debt ceiling, which hopefully happens next week, whatever is going to happen, and you're going to see some motion upward here, because I feel like it's suppressed the upward motion that should have happened already. That's going to kind of come. There's always some euphoria from the debt ceiling, resolution anyway. And we'll get back to the basics of inflation and what the Federal Reserve is going to do. So that's important today, because the PCE is the Personal Consumption Expenditure Index, was pushed out today. This is the measure that the Federal Reserve looks at for inflation, People talk about CPI and PPI and all these things, but if you listen to Jay Powell's speech, he talks about PCE.
Yep.
It is their favored measure. And there's a bunch of reasons why. We've talked about them before. But just understand, when they talk about 2%, they're not talking about CPI. They're talking about PCE, and they're talking about core PCE, after food and energy are taken out. Well, we got some semi-bad news today on core PCE because it went up a little bit.
Yep.
It went from 4.63 to 4.7%, not a bunch, but it's been kind of around that 4.6, 4.7 arena for a while now.
Yeah, the last 4 months has kind of been stuck in that area.
Exactly, and so the trend is kind of flattening out, and we were talking about this earlier, but the bet on whether or not the Federal Reserve would be raising rates, right? On you give them the numbers. So on May 10th, it was
May 10th, it was 99% that they would just hold the rates.
Yeah.
And as of today, is switched that 66% chance that they raise rates at the next meeting, and 33% they hold. That's right,
and 33%. So think about that. That's a big difference.
Yeah.
So I went from we're not going to raise rates on the betting side of it, the futures market, to but more likely that we're going to raise rates again. And obviously it has to do with these numbers that are coming out. Inflation is a little sticky. It's hanging in there. It's not going up dramatically, but it's not coming down. And the trend of coming down has kind of slowed down. And again, PCE is a little bit more difficult to get down. It's got more service bases in it. And you were saying today that even the goods were up a bit more than expected.
Yeah. And in March, goods were down negative 0.2. While this month it's 0.3, and service was kind of the same month to month. So it's the goods now were the one that kind of brought it up this time.
Yeah, so let's think about this for just a second. I'll finish up on this thought process. So all the way through here, last 12 months, I'd say 9 out of 10 articles are talking about the great big recession that's coming, how much the stock market's going to drop, 5, 10, 15, 20% drop from here, how earnings are going to be affected, how all of these things are going to happen, and absolutely none of these have come true. And it was already supposed to be happening now. The gentleman that won the #1 analyst award for last year said that this second quarter, which ends just in a few weeks here at the end of June, we would be back down about 20% from where we are now. That has not happened, right? And so I think one of the things that's happening is that when we look at the traditional measures, when you raise rates this much, we should be having a recession. The stock market should be lower than where it is.
Yep.
But this is an unusual scenario because we had a pandemic. And during that pandemic, the government did put out a lot of money. They lowered interest rates. So businesses and households refinanced at very low rates. They're healthier than they were prior to the pandemic because of that. And everybody got a chance now to go out and do things. And they're still coming out of the woodworks. I have clients that are still being conservative, but less so. And what that means is you're getting out to the restaurants, they're getting out to the airports, they're getting out to the hotels, and they're doing things. And I'm hearing a lot more of that from my clientele. And so what's happening is that the pent-up demand and the results from the pandemic are not in the data that we're looking at. Last time we had inflation in the 70s, no pandemic. Last time we had higher interest rate increases in the 70s and beyond, no pandemic. So the pandemic side is pushing the economy upward, and then the higher interest rates are pushing the economy and slowing things down. And we're going right down the middle. And if you look right here, I mean, I have a lot of weeks here we haven't moved that much.
Yeah, it's kind of just ranging very tightly too.
And actually, if you go back and follow that little dotted line all the way back, that's basically May of last year. We're at the same spot. And so those two forces are offsetting each other. I don't think that's being accounted for enough. And the debt ceiling is probably making us go sideways somewhat so here. We might be a little higher right now, obviously, without the debt ceiling. And maybe we'll make that up here if they do get a resolution. So things are not bad. Maybe they will get so, and we'll be watching for that. But if you look at the price of the stock market, it is telling you that, things are okay. And the stock market is a prediction mechanism. It is looking forward 3 to 18 months. And it is saying right now that things aren't going to be that terrible, right? Sometimes the market's off, but it's right more than it's wrong, and it's why it's the S&P 500 in the leading economic index. There's 10 pieces in there. And the S&P 500 is one of those 10 pieces that's considered one of the leading indicators of the economy. So look at that. It's not as bad as people are putting in these articles that we're all reading. And so, obviously negative sells. We try to point out some of the positive too. We're not, going to be Pollyannish here, but these things are not that bad. So that's what's happening so far. Good day today too, which is great. All right. Well, let's cover some of the questions that are coming up.
Sure. Um, what are you going to do as we get closer and closer to the debt ceiling?
Yeah. So this is kind of an interesting question because we get lots of calls this week, emails, different things. People are asking exactly that. What are we going to do? And what's nice about what we have at the moment and what we've had here since, the middle of 2022 is we have a really nice system of basically triggers, and that's what the lights are for, the green, the yellow, the red, etc. And so when we're green, we're buying pieces that are in the market, sometimes, just trying to, even buy things that might do better than the market. That's been true this week, last week, for example. When we're yellow, we're buying things that have lower risk, still in the market, but moving down in risk, and maybe have things that have less risk than the market. So if the market does go up in that environment, we'll still make some money. But if the market goes down, maybe we lose less.
Yeah.
So that's good. When we get to red, and then we start to move into things like T-bills and pull pieces out of the market altogether. And so one of the key things that we look at is the market. Because we have a strong belief that the market has the information in it already. So look at what's happening with the market. How many people have run out of the market here because of this debt ceiling issue, to now miss out on this run up that we're having? Let's react to what actually happens. And so, for example, and here we got the signals here for the bond market here on the screen. We've reacted to that. We have a red on the fast signal. That means that we have moved into kind of T-bills and very short-term, instruments for our IRA type assets. And yellow meaning that we've moved into bond portfolio pieces that have less risk than the overall bond market. We're reacting to what we're seeing in the overall bond market. And again, the overall bond market seems to be reacting to the debt ceiling issue of, hey, once they solve it, the Treasury's going to have to put out a bunch of bonds all at once, and that's going to make a big supply for demand that is, even if it stays the same, the supply and demand, more supply makes the price go down if demand stays the same. So, we're reacting to the price. So it's the same mechanism we would use in any scenario, whether it is, a debt ceiling or not. For all intents and purposes, I actually really like a buy and hold scenario. It sure is a lot easier. The problem is that you can go through some situations that can really push your financial scenario very close to the brink.
Yeah.
And, I'm classically trained. I'm a finance major. I get the buy and hold scenario. And I like that. And we try as much as possible to kind of stay in the market all the time. However, the Great Depression, the market dropped 87%, and it took 15 years to get back. If you're 75 years old, are you going to wait until 90, before your money comes back? And obviously, you have to live during that period of time. You're probably withdrawing from those assets. So it really kind of depends on the situation. You have to be careful because there can be some big downturns. It wasn't that long ago we had a 57% downturn with the S&P 500, in the 2008 downturn. So again, I think the process is to have something that is a triggering mechanism. Maybe you can be a little bit faster in your triggers in your IRAs. We no longer have the big transaction costs inside of the, motion. We buy exchange traded funds without commissions, which is nice. And so we don't have to worry about that. And if it's in an IRA, you don't have to put it down in your tax return, which can be a real pain. We use our slow triggers for those, taxable issues where we don't want to change as often because it's just a pain to put all those things down in your tax return. And certainly if you generate a lot of gains, you end up having to pay taxes on it right then instead of deferring it till later. And so that, that's why we have those two systems in place. But both are designed to go to a place of safety in a period of extreme stress and wait it out. And we might lose out on the upside, right, if things start to really move. But we prioritize capital preservation, and our clients appreciate that. So I think that's a really important component. Now, one problem with the debt ceiling, okay, and this is where it really, really gets difficult. Market starts to come down. We start to get to a yellow or red signals on both our fast and slow. because they're still debating the debt ceiling. We're getting closer and closer to the edge. Does seem like some chaos might be necessary in order to get everybody off the dime to sign the thing. But it is not a normal downturn. Like 2022, market was coming down kind of a normal. We had an invasion of Ukraine. We had higher interest rates and high inflation. Those things weren't going to be solved overnight. The debt ceiling can be solved overnight.
Yeah, you just need everyone to sign the bill, and you're good.
It's a group of people deciding on something. It's not that the U.S. government doesn't have the money or the wherewithal or the cash flow ultimately to pay the debt and borrow money to pay the rest. They do. It's just this artificial constraint. So what happens is if you get out of the market here and try to protect yourself, you do have to accept the fact that you're probably going to lose out when it jumps 5-10% so quickly you can't get back in once they resolve it.
Yeah,
right?
It's a pretty rapid ascent. Right?
Yeah, if you look back, especially the last couple, just look back at September, October of 21, and end of November, Thanksgiving time of 2021. Also, you can see how fast the market came back. It was very strong, and it went way past where it was even after the drop. So. We're not even having a drop here. Maybe we don't have quite as much run because we haven't had a drop, but we're going to have a run here, and so that's the issue with the debt ceiling. You have to be careful with. And again, the market is already moving. We are green right now, and we're in there. Maybe it's moving because there's some knowledge that the debt ceiling is really close, and the debt ceiling agreement. So we'll see. Good question.
What happens to money markets and stable value funds in a U.S. default?
Yeah, so money markets are, basically buying a lot, well, not all of them, but a lot of the treasury bonds.
Short-term kind of investment.
And so you were telling me today, why don't you tell them kind of what Schwab is doing? We got notice, TD Ameritrade, who we clear through, has merged with Schwab. And everything's getting moved over as we speak, so TD Ameritrade name will eventually disappear, actually. So Schwab was putting out a notice on, what they were doing with their stable value or money markets.
Yeah, so essentially Schwab, if they have any kind of like money market that was denoted in treasuries, based on treasuries, they were going to try and switch a portion of their portfolio into government agencies. They're going to not have those treasuries as allowed by their investment strategy. And they're keeping extra cash on hand. So like money markets and stable value funds, they always stay at $1. And so breaking the buck is kind of like the term they say when it drops below that $1. And so Schwab's having on hand cash to basically prevent that from falling apart.
Yeah. One of the ironies is, if you read the articles, people are moving money into short-term treasuries in one way or another, either directly or into these money markets, which is kind of counterintuitive. The U.S. is theoretically defaulting on its obligations. However, what's going to happen? I would say the consensus is that the U.S. is not going to default on its actual treasury debt. They have lots of different things that they can look at and not pay, at least for a short period of time, outside of the treasury debt. I would not say that that's at the top of their list. I hope the top of their list is cutting back or eliminating Congress's pay for the period of time until they sign something. So not that that will solve the problem, but you never know, actually. It's not a big dollar amount, but it's a big issue to those people to not get paid. And that might get some people off the dime and get them voting for this thing and get this done with. So I suspect it gets done. However, it is kind of ironic that there's so much money moving towards an area. And again, I think they're going to be okay. The consensus is that the U.S. will continue to pay its treasury obligations because that's kind of a bedrock for everything else. You let that go, and there could be other issues because going forward, we still need to be able to issue treasuries. We have a deficit. We do not bring in as much money as we spend, and we haven't for a very long period of time. And so, having that ability to borrow is super important. and defaulting on, or even short-term defaulting on some of these obligations would hurt our ratings. So it's a much more expensive issue to default on that. So I think people are probably okay in those money markets also. But some of these companies are doing things to try to, protect that also.
Yeah, they're going to hedge their bets essentially.
Yeah, yeah.
Um, what does a strong dollar mean for the U.S. stock market? Also, the yen and franc have been doing well in the past couple of weeks.
What does a strong dollar mean? Okay, so one of the things that's kind of interesting is historically, when the dollar goes up, the market goes down. Sometimes at least on a short-term basis. And we have seen that actually. If you lay a chart of the dollar and the S&P 500 on top of each other, they're what they call inversely correlated. That just means they go in the opposite direction. Dollar up, market down, dollar down, market up. Well, if you look at the last couple of weeks, dollar's up a lot, which is kind of mind-boggling actually. Why is the dollar up? I can see why the yen and the franc are going right. Why is the dollar up facing a default? Because usually when the dollar's up, that means people are flooding into the market, into the country to buy treasuries, and there's lots of reasons dollar goes up, but that's one of the big ones. And so nonetheless, the dollar's up, but so is the market. Yeah, I mean, even in this last couple of weeks here, the market's up also. So usually that correlation is not what is happening right now. Maybe I do think that correlation makes sense because it just happens that the dollar moves up and it makes our securities more expensive to the rest of the world, right? And so there's some other areas that they might go as far as that goes. So right at the moment they're both going the same direction. Luckily they're both going up, so hey, that's good. But I would think there's going to be some pressure on the stock market from a rising dollar.
Yeah, in the long term, whenever dollar goes up, stock market goes down.
And actually, I probably would, if I was going to bet on something, I would bet that the dollar actually retreats some upon a debt ceiling, agreement, and the stock market continues up.
Yeah,
that would make more sense to me. But we'll see what happens.
How does April's PCE change the Fed's rate decision in June?
So the April PCE is the Personal Consumption Expenditure Index. This is a measure of inflation. It is a different basket of goods from CPI. Lots of differences as to how they calculate that inflation. It is the favored measure for the Federal Reserve. And I can't tell you how many articles I read saying, they got to go from 9%, which is where CPI was. PCE never got there. You got to go from 9% down to 2%. Totally inaccurate. Actually have to take PCE and take out food and energy to figure out what's called core PCE. And that's what they got to get down to 2. And so PCE went up a little bit in April. Went from 4.63% on the core to 4.7% in April. And so, and that's not good. It's not terrible. Essentially, it's been at the same level for quite a few months.
Yeah, right? Even just regular PCE is below core, which is kind of unusual to have food and energy to be kind of in a deflation.
You're seeing some deflationary pressure, especially energy. But even in the food arena, partly because food was going at 10 to 15%, so it's just starting to slow down some. But what's happening is that again, we've seen the futures market as of the beginning of this month say 99% chance the Fed is not going to be raising rates in June. June 13th, 14th is the meeting, right? And now we're at a 66% chance that the Fed will be raising rates, right? That's the bet right now. And so that has a lot to do with, I think, what's coming out from these inflation numbers from PCE. So I think there's some pressure on the Fed to actually raise rates again, which would be a surprise to the market to a certain degree. However, at the same time, the Fed governors have come out and talked about this debt ceiling issue. So if the debt ceiling is not resolved by the 13th and 14th, they will not be raising rates, in my opinion.
Yeah, right? And if you look into July too, they're saying we were predicting us going down actually.
Yes, yeah, they was predicting a 1/4 point cut in July. I remember at the beginning of May, that was maybe a 50-50 chance.
Yeah, and now it's looking at, is there going to be another increase too?
Yeah, Yeah, exactly. And it's just not unusual. Inflation can be quite sticky because you get these kind of spirals. Inflation's there, and then employees need more money, to buy the same things, and so they get higher pay or ask for higher pay, and then of course that pay gets passed on to higher cost of goods up to a point. You can't continuously raise prices. You know, but the economy's pretty good. The pent up demand's there. People are willing to spend the money. So that's so far the pass through has been working. They've been passing through those costs to higher wages. Higher prices for goods and services. And so, eventually that stops and starts to compress the earnings. Because if companies can't raise their prices, but their costs are going up, they're going to make less. And that has been the whole fear of this downturn mentality that's happened, and that of course just hasn't happened yet. So I think that it does have an impact. It's going to be more of the story once we get here. Let's assume the debt ceiling is solved. That will take that off the table for the June 13th, 14th, Fed meeting, and they'll just be able to focus on inflation. And I wouldn't be surprised to see a rate increase to get us to basically 5.25 from 5% on the Fed funds rate, just because they're not seeing as much motion to the downside, and they can push a bit more because the job market is still really, really good. Yeah. And that's their other. They have a dual mandate: low inflation. They pick 2%, and full employment. Right? Yeah. We have full employment, that's for sure. And so they can push on the rate increases. The danger is always that they raise rates today and don't see an impact in the market for 3 to 18 months, in the economy. So, that's where everybody worries, because the Fed historically over raises rates. And that's because of this lag. It's very, very difficult to tell what to do. They're literally might be responding to a report that just came out today on the 26th of May, that they're going to make a change for June 13th and 14th. That might not have an impact to the economy for quite some time, even next year. So that's why they generally overraise rates.
Yeah, you got to think about it. They're making a decision based on an April report in June. And so there's also that lag on that data.
Yeah, exactly. I mean, things could have softened between then. I mean, they do have probably some more foresight to see things than we do. But nonetheless, historically, they have overraised rates. And even historically did the opposite. In the pandemic, they didn't raise rates fast enough in the end. That's for sure. All right. Well, that's our show for today. I want to thank everybody so much for coming. Really enjoyed great questions today. Really. We will not be here next week. I'm actually away for conference and some little bit of vacation. I will be doing the video, the daily video on Thursday, but not be doing it on Tuesday, Wednesday. Monday's holiday, of course, and not be doing it Friday because we're out on Friday. So next week is just the Thursday video, and then we'll pick up the normal schedule after that. So look forward to being able to see you again in a couple weeks. Thank you for joining us today. You can send in your questions now. Give us a chance to answer those and what have you, and send that to the email address asktom@talkmoneywithtom.com. You can go to our channel and subscribe. Hit the subscribe button, hit the bell button, put in some comments, put in some likes, whatever you'd like to do. All that stuff helps us, which is great, but hopefully it helps you more than anything. That's our main objective here. And of course, lastly is just, if you want to meet with Ethan and I, you can go to our website, push that yellow book appointment button you see up in the corner, and set up a 30-minute, video or phone time to meet with Ethan and I. So I want to thank everybody so much for coming today. Really looking forward to being able to talk to you again in a couple weeks, and hopefully we can answer some more questions. Thank you.